So good afternoon, everybody. So it's 2 o'clock Brussels time. Some of you might be following from the United States, so it's a little bit earlier. But good afternoon to all. We have today a great panel and an online seminar on global perspective of NBFI. The NBFI has been at the center of the international agenda now for some time. There is a kind of activity at the national level in different jurisdiction in order to tackle the issue, so with different initiative. So we thought that it would have been a very good opportunity to discuss this issue, giving a perspective from the different jurisdiction at the FBF. FBF, the Florence School of Banking and Finance, is centered in wonderful hills of Tuscany. I invite you all to visit it. Unfortunately, I'm in Brussels. I mean, fortunately for me, but unfortunately not to be in Florence. But I wish I was there with some of our speakers. We have, as I said, a great panel. We will have Lee Folger, Director of Financial Stability, Strategy and Risk from the Bank of England. François Haas, Deputy Director General on Financial Stability from the Banque de France. Unfortunately, Sandra Lee, Deputy Assistant Secretary from the FSOC, from the US Treasury, will not be able to join us because of some health issue, nothing major, but it was caught basically between yesterday and today. As discussed, we will be joined by John Wemstrong, Senior Policy Advisor from IOSCO, then Thorsten Beck, Director of the Florence School of Banking and Finance, and then Sarah Hammer, Executive Director of the Wharton School. So as I said, a great panel, many nice presentations. I would start with Lee Folger, giving us a little bit a presentation of the report and the outcome of the SWES. So Lee, the floor is yours.
Great, thanks Emiliano, and thanks for having me at this session. Let me try to share my screen. It did work earlier, so we'll give it a go now. Can you all see that?
Yes, it works perfectly. Thanks.
Great. The next challenge is for me to be able to change the slides. So thanks a lot for having me. I'm keen to present the results of our system-wide exploratory scenario, and I'll talk you through two things that are covered in the report. So firstly, the aims and how we did it, the aims of the scenario, the aims of the exercise and how we did it. And then secondly, what results we got from the exercise and where we might go next with system-wide scenarios of this kind. So let me flick to, let me just check if I can flick to the next slide. Yep. So on the aims in the scenario, we had two aims for this exercise. Firstly, it was to enhance our understanding of the risks to and from NBFIs and non-banks and the behavior of non-banks and banks in stress. And the important thing under one here is what drives those behaviors as well. So we wanted to observe the behaviors, but we also wanted to understand the why as well. And that you'll see some of that in the results that I present shortly. And then the second thing, and the really important thing as well, is to understand how those behaviors and the market dynamics can interact to amplify the shock and potentially pose risks to financial stability. So two aims, behaviors and the motivations, and then how you add them up and what that means in terms of market outcomes. I'm going to just flick up this slide. This is in the report, so you can have a look at your leisure. But really, this is a bit of a map of the sorts of things we were seeking to test in the exercise. And the bit in the middle, I think, is the key thing here, that when you have a sort of stress test of this kind, you've got to work out what your focus is, because you can't stress the whole world and look at every possible interaction. And so we decided to make our focus core UK financial markets, and that in our definition was the gilt market, the gilt repo market, corporate bond markets, and associated derivatives markets as well. We planned the exercise, and there were two kind of key elements to that. Firstly, how we would get the right engagement and the right coverage, and then secondly, what the scenario would be. So For the first of those two things, we included on a voluntary basis 50 participants from across the financial sector. They weren't just UK firms, and we basically looked at which firms had the most presence in those UK core markets that we were interested in. And we also sought to get a diversity of firms and behaviours and strategies. So not just the biggest, but also a range of types of firms as well, to see kind of how different types of firms and different strategies would operate in those markets. So we had 50 participants, banks, insurers, hedge funds, LDI funds, pension funds, CCPs, money market funds, open-ended fund, your standard mutual funds as well. And we worked with those participants to design the scenario, and we wanted a scenario. We didn't want a scenario that would break the entire financial system, because that doesn't tell you a lot of information. We wanted a scenario that would put a significant degree of stress on a range of market participants operating in core UK markets, and we designed the scenario in that way. And the scenario, the picture on the right there, you can see sort of sets out the parameterization of that scenario in the context of the historical distributions, and you can kind of think of it as elements of the LDI stress that the UK had, so a big jump in government yields, but also elements of what we saw in the Dash for Cash in 2020, which was a significant widening of spreads as well. So we had those two effects going on. There's a lot more to the scenario. We described the scenario was driven by geopolitical events that would have macroeconomic consequences, that it would last over, the exercise would last over a 2-week period, but the scenario itself, the resolution of the scenario would remain uncertain at the end of those 2 weeks. So we tried to capture some of that uncertainty in the exercise. And we asked participants how they would react to that 2-week market stress. The scenario we also said to participants that there was some counterparty credit risk in the scenario. So we asked participants to assume there was a default of a non-participating relative value focused hedge fund. And we asked participants to give us daily balance sheet information through the course of that 2-week stress of the scenario. Now, to get to the amplification and the kind of second round effects, we actually decided to run the scenario in 2 rounds. So we asked participants to tell us how they'd react to the shock. Then we effectively added up all of those responses, checked the consistency across them, and then reran the scenario following the shock. And that really helped us understand both what the collective impact of all those actions was, but also whether there were mismatches in expectations between firms within the scenario. I'll flick to the next slide. This is kind of what we saw from the responses. This walks you through that, and I'll break this down into 3 parts as we go. Firstly, we did see a very significant and rapid liquidity redistribution around the UK financial system as a result. And as a result of that, non-banks had to take actions to either recapitalize themselves, source collateral, or deleverage their positions. And if I flick to the first 2 of those, this chart I think helps illustrate the effect of the scenario. So on the left-hand side, you see effectively what the scenario is doing in terms of creating liquidity demands for market participants. So around 95 billion of liquidity demands in the system. The bar in the middle shows you how participants met those demands. And as you can see, the biggest demand was on the variation margin side, and the biggest response was pledging securities. But firms also rolled repo, sought to roll repo. They also used some cash, and they also redeemed from funds as well. The third column on the far right, and I think this is the one that's interesting, is the actions the non-banks took to restore their buffers, if you like, after having experienced this shock. I don't think, strictly speaking, this is correct, but I like to think of it as sort of the amplifying piece of part of the stress as a way to visualize that, because what's happening there is you have the stress and participants are taking action to rebuild their buffers very quickly, and that leads to things like asset sales in the scenario. So you can define amplification in many ways. Very hard to picture it in this scenario, but I think that is a nice way of just showing that. The second sort of action that we saw through the scenario was that financial intermediaries have limited appetite to take on additional risk in core markets. So that may not be surprising in a stress of this kind, an uncertain, geopolitically driven stress, but it is material to the results. And what you see is that banks are largely willing to roll repo positions, but they do shorten tenors and tighten terms of those positions. So there's an impact there. But what they generally are not willing to do is offer additional repo through this stress. And the chart on the left shows the willingness to provide additional repo, with the orange bars being not willing by sector. The chart on the right shows the fact that actually haircuts on repo collateral increase significantly in the scenario, so doubling in most cases. And so that just shows the tightening of terms. So banks are there; they're going to kind of support through the stress, but they're not going to lean into the stress in the scenario that we put out there. And what you see as a result of that is that some core UK markets come under pressure. And I'll start with the result that was perhaps the most interesting or least expected one for us, which is that participants, mainly insurers and pension schemes, take action in this scenario. And one of the actions they take is selling corporate bonds. Insurers do that in the most part because corporate bonds have become riskier. And so there's a kind of regulatory capital type effect going on there, and a return on capital type effect as a result. Pension schemes are selling corporate bonds here to source liquidity to recapitalize their LDI funds that are increasing in leverage as gilt yields have gone up. And what we saw in the scenario that we did was that sales orders outpaced willingness to purchase in the corporate bond market. We tested that with participants in the second round, in that we asked them, the corporate bond prices are likely to move by even more than you thought in this scenario because there's lots of price insensitive selling. Would you still do that? And many participants said, yes, we would. We don't have any other option in this scenario. And we asked people, would you buy corporate bonds in this scenario? And they said, well, in this type of stress, at this pace, probably not. But, over time, if we thought the market was reaching a new price equilibrium, we'd be willing to come into the market. But that time gap, I think, is an important one to bear in mind. The second conclusion, which was a reassuring one, was that the gilt market was broadly in balance in the scenario. And I think the kind of thing to take away from that is that what we saw in the scenario was significantly increased resilience in market participants since the dash for cash in March 2020. Money market funds holding much bigger buffers, LDI funds having deleveraged significantly, insurers having found having secured the ability to post corporate bonds as collateral through CSAs. And what happens in the scenario is that sales orders and purchases broadly balance, and that's largely due to that increased resilience. Now, there's quite a few sensitivities in the report that we call out here because the scenario is a stylized scenario, obviously, and we wanted to look into why might this not be the case. Two things I'd call out very briefly are we've seen hedge fund positioning change rapidly since we did the scenario. So hedge funds were kind of net flat in terms of repo borrowing as a sector during when we ran the scenario. Now they're significant repo borrowers. And obviously, if banks are under any stress themselves, you might see them being less willing to extend repo in the scenario. So there's some sensitivities to that, but broadly speaking, a lot more increased resilience. The last thing I'll just mention, and then I'll just jump onto our conclusions and wrap up, is that what we did see in the through the Suez, which was really interesting and useful for market participants as well, is a number of mismatches in participants' expectations of how other participants would react in the scenario. And we've highlighted all of them in the report, and I've mentioned them in a speech a couple of weeks ago. The one that I've got on this chart here just shows expectations of initial margin calls by participants from CCPs. And what we saw in the exercise was participants expected initial margin calls to be on average 8 or 9 times larger than they actually were by CCP. So in a way that was reassuring because participants expected bigger calls. But we also did suggest the possibility that this could be a symmetric risk, and there might be times in future where participants would underestimate calls as stresses fall out of CCP models and things like that. So something to really note there. Right, I'll just wrap up with our key findings, some of them which I've covered already. So firstly, we did see amplification in the scenario. It was really interesting. But we've also seen an increase in non-bank resilience as well over the past few years. Great news. Not all of that is as a result of regulatory requirements. So there's a question about how that would change over time and what factors would cause that to change. And I think that underlines the importance of the FSB agenda on non-banks. Secondly, we see that banks are unlikely to provide all of the additional repo that might be demanded in a stress. And I think that leads us to think we need to, in terms of policy work, focus on the resilience of the repo market and think about that a bit more carefully. Thirdly, we've seen improvements to gilt market resilience, mostly because of actions taken after the LDI episode and the recommendations that the FPC put in place. But those sensitivities that I mentioned mean that we probably need to keep monitoring this and think about how we kind of test this over time. The fourth one is the sterling corporate bond conclusion, which I mentioned. And as a result of that, the pensions regulator in the UK is going to work with pension funds on their behaviours in stress, because that's kind of been the key kind of learning from that. And then the last one is that we thought this was a really useful, the system-wide exercise we did was a very useful tool to understanding dynamics in stress across the non-bank sector, and in particular the behavioural dynamics. I think the beauty of this exercise is we didn't assume behaviours, we tested them. And that's really, really important in understanding how real stresses would play out. So we plan to do two things. Firstly, invest in our desktop capability to do more of these sorts of exercises. We've learned a lot about how to do that through this work. We will still need to engage with the sector to understand that behavioural piece, but we think we can do it more efficiently and in a lighter touch way in future. And then secondly, that actually this type of exercise is probably useful for other sorts of vulnerabilities and risks. And we should think about, either for other jurisdictions, other authorities or other issues, whether system-wide type exercises would be the right ones. I will stop there and hand back to Emiliano, I think.
Well, thank you, Lee. I think very useful input. It's reassuring in a way, two elements. That many of the issues that you mentioned are part of the same agenda in many jurisdictions. This is partially driven, I would say, from the FSB agenda, as you mentioned, but also for actually the fact that probably we have identified or we are identifying the issues which might be more critical. Secondly, is reassuring in terms of results. I mean, what you communicate to us seems to be kind of positive in how basically so far the NBFI has shown resilience or can show resilience, but still the situation should be under monitoring. So we shouldn't lower our guard. And third, I think there is a lot of lesson learned, no, in terms of experience, and you are at the forefront, but certainly this is something that we can all experience from. And this is important because stress test is also a core element of the NBFI consultation that the Commission is conducting and which has triggered, I mean, for your information, more than 100 responses. So they will be published on the website. So now it's for us to go through that. One of them has been prepared by the Eurosystem. We have François as Deputy Director General of the Banque de France on Financial Stability, who has coordinated co-chaired a high-level task force in order to prepare the response. Maybe François will give you the floor to go a little bit through the response of the group. Please, François.
Sorry. I was trying to share my slides, but I'm not sure you see them.
We see them now.
Okay.
I think you should probably be in presentation mode. Yes.
All right. Okay. Thanks a lot, Emiliano. Thanks, Lee. I have a very small number of slides. Sorry. Okay. So first of all, some elements on the context. We just before the Commission launched this consultation, we had the Eurosystem had decided to work on this topic of NBFI, and we had decided to set up a so-called high-level task force, which I was very lucky to co-chair with my colleague from the Central Bank of Ireland. And we had so most of the work that we did in this task force last year until the end of this year was devoted to this NBFI issue and preparing an answer for the Commission's consultation. First of all, so that's for the element of context. What the starting point of our work was basically to take note of the significant growth of NBFI not only in Europe, but more globally. And within this broad sector of NBFI, we were especially attracted by the growth of the asset management industry in various forms. Recognizing also at the same time, of course, that NBFI is a very heterogeneous group, different entities, different activities, but the striking point was the growth of the investment industry and the asset management industry. We also, one of the elements of this starting point was to note that whereas a large part of this NBFI complex is subject to some form of regulation, this regulation, when it exists, has not been designed with a macro-prudential framework and a macro-prudential view, but was based on the premises of protecting investors and promoting fair and efficient markets. So the macro-prudential dimension is absent, and that was one of the motivations of our work. Of course, this was also fed by some of the episodes that we saw recently of stress and episodes that required the intervention of central banks to restore market funding. This was also a large motivation of the work. We felt that there was this sentiment which was developing that whatever happens, in the end, central banks will step in and save the day. And we felt that this was not really appropriate. And the idea of designing a macro-prudential framework is also the result of this discomfort with the current situation. So we did this work during most of the year. The main principle that we adopted to that was to take system-wide perspective, and I mean this is exactly what Lee has shown, and what we wanted to do is to have this broad perspective in order to be able to understand, assess all the interconnections between the different participants. we also recognized from the beginning that the kind of macro-prudential framework that we would end up with had to be tailored to the diversity of NBFI actors. There was this idea initially that we heard from a lot of participants that we were basically aiming at transposing the banking prudential framework to NBFI, which is definitely not the objective, and which would definitely be a very wrong approach. So precisely because of the diversity of NBFI actors, so we need to spell out this to dispel this idea. Of course, as in any kind of work of this type, we need to have a clear balance between the cost and the benefits, and between the need to keep the market in having the ability to take risk, and also the need to increase its resilience and provide some safety to the system. In fact, the idea was definitely from the start to build resistance and to build it to the extent possible ex ante before any shock hits, because it's always more difficult to step in ex post than to build a system, resilient system ex ante. So, and of course, this is especially true when it comes to Europe. There was a need to come up with a framework which allows coordination and which allows consistency among the different participants, among the different authorities which would be involved in this framework. And as you may know, where the complexity of the financial architecture is especially strong in Europe, I would say. So, sorry. Okay. Not sure my. All right. So we came ultimately with a small number of recommendation for this NBFI framework, macroprudential framework. Basically, there are 6 lines that we looked at. The first one, the most obvious one, I would say, was that we feel that there is a need for Europe to implement the reforms, the recommendation that were agreed at the international level, meaning at the FSB mostly. A number of these recommendations have not yet been implemented in Europe, and we feel that this is absolutely needed. Starting with the recommendation on money market fund resilience. We also feel that there is a need for Europe to implement the open-ended fund resilience recommendation, and including with the focus on liquidity, the use of anti-dilution tools, and the bucketing approach. There is ongoing work also on liquidity preparedness on non-bank market participants for margin and collateral calls that needs to be implemented also. And lastly, we feel that the work on leverage, which is also very important, the work on leverage, which is conducted at the FSB, will need to be implemented when it's completed at the European level. So first set of recommendation, implementation of FSB recommendations on NBFI. Oh, sorry, I've got some problem with my screen. Okay, should be. Let me. Okay, sorry. So second series of recommendation. The need to enhance the macroprudential toolkit for NBFI, and again, as I mentioned, with a focus on ex ante rather than ex post tools. That basically means, because there are some gaps in this framework as of today, and we have basically we have two series of recommendations. One is on the introduction of an explicit macro-prudential tool to mitigate risk that can arise from liquidity mismatches in open-ended funds. With the idea of giving a priority for this implementation on to liability side powers, for instance, notice periods. The idea here is derived from the Article 25 of AIFM, and we feel that this could be implemented. There must be a way to implement this kind of approach to liquidity mismatch in open-ended funds. The second tool that we looked at relates to leverage. The idea here is to make sure that all UCITS funds do report appropriately their value at risk and disclose regularly the level of leverage that they have, with the idea that if need be, this could be complemented with the possibility to impose some restrictions on leverage if need be. Oh, sorry. The third point, obviously, is to and that will really not surprise you, is to introduce and to use system-wide stress testing in Europe. I mean, I think for those of you who are not convinced, the presentation that Lee gave is very telling and very convincing. We do feel that introducing this kind of approach in Europe, in continental Europe, in the EU, is something that needs to be a priority going forward.
Maybe François, sorry, just because
Yeah.
you're showing your desktop, so in case you want to stop to share, but please, I think make your conclusions, and then I think we can have a nice exchange also with the other discussants.
So you don't see my slide?
I don't. No, we don't see your slides anymore. We see your screen, but I think you were the last slide, no, on the conclusions.
That's very odd, because I do see the slides anyway. Okay, so stress testing, definitely something that needs to be implemented. We feel it's. I mean, again, I will not repeat what Lee said, but this is a great tool to identify shocks and transmission and identify transmission channel of shocks, and to identify the different linkages between entities, between markets, and between activities. It's also, in our view, an interesting way to identify and fix data gaps that we still have. And in fact, the fourth recommendation that we have relates to data and the need to have better data on NBFI. That means two things, basically. One is to make sure that we share in a much better way, much smoother way, the data that we have, and that means the central bank, the supervisors, and the different European agencies. We have a number of databases. We need to be able to share them in a much more efficient way, which means some legal work, some work on the legal framework, and also some work on the operational approach. We also need to be able to share data more efficiently between across jurisdictions, both at the European level and abroad. Obviously, we have global markets, and this sharing of data needs to be done at the highest level. Fifth recommendation relates to governance, and here we have two recommendations that we put forward. One relates to the possibility of implement this so-called reciprocation system to avoid any cross-border leakages. And basically, that means that ESMA, in the case of Europe, would be able to assess whether a national measure proposed or implemented by a member state should be applied across the EU in a similar way. That's a sort of horizontal power. We also add to that a more vertical power, which is called the top-up powers, which would allow again ESMA to add on a measure taken by a national authority. All this would be done within the context of the European framework, which means that the SRB would be consulted, and of course this would be done with the cooperation of national authorities. Last series of recommendation, because we are faced with a system which evolves quite rapidly. We saw it recently. We also see that the type of funds, the type of activities is also morphing very quickly. For instance, we see today the quite significant and impressive development of private debt fund. So we feel that whatever we do needs to be done in a flexible way in order to be able to adjust to this change in the environment. And we also feel that this is the case also because a number of funds that we have in Europe are not regulated either under UCITS framework or under the Alternative Investment Management Directive. But they basically conduct the same activity and they also present the same kind of risk. So there is a need to be nimble and to have a global approach which could adjust as the context and the market evolve. This means, for instance, that the search for data should not be limited to a regulated entity, but should be able to go beyond that. It means also that we should, in our approach to NBFI, we should combine both an entity and an activity-based approach in order to have the most comprehensive approach to the risk and in order to be able to build the resilience that is needed.
François, on this point, probably I would just in terms of time, because also we have 3 other speakers, I will try really to build a bridge. Sandra unfortunately cannot be here, but I also invite all participants to read the report on financial stability of the FSOC, because it takes back many of the issues that you already mentioned in your paper, in the report of the Eurosystem, so which shows consistency. They mention, of course, money market funds, open-ended funds, exchange of data, also cross-border. So that's a topic which also in the papers that we have received in our consultation comes across a lot, and also broad support on the stress test. But I mean, we have seen and we heard the banking perspective. We also have John Vermstrom from IOSCO, Senior Policy Advisor. Maybe you can react from the market supervisor perspective. Maybe you can give us a little bit your point of view.
Sure. Thank you, Emiliano. It's great to be here. I guess the usual disclaimer is that the views are my own, not necessarily that of IOSCO or its members. But I'll react quickly. I want to start with the Suez. And first of all, I think it's a really incredible piece of work from the bank. I think it's a testament not only to the quality and capability of the bank, but also the sort of collaborative relationship they've managed to build and also maintain with the industry. And I think there's a high level of trust and respect that makes an exercise like that even possible. But that does sort of raise the question to me a little bit on whether it's possible to replicate such an exercise elsewhere. I think perhaps in Europe or parts of Asia, it could be possible, but I imagine it might be challenging in jurisdictions like the US. But then, so perhaps a bit more specifically on the contents of the SWES findings. So I found it really interesting the urgency in which pension funds try to rebuild the headroom above sort of the reg buffers, and also the sort of potential cascading effects this has. And linked to this is also the, I would say, almost mechanistic way that the pension funds respond and sell assets. This seems to be sort of the major market force in the UK, particularly under stress. And I wondered whether there was thought, or there should be thought about loosening sort of the chain of events there. I did find surprising that there was still a rather large mismatch in the expected behavior between the market participants, particularly from the providers of liquidity to the seekers of liquidity. We saw that sort of recent stress events, particularly in March 2020, but also in others, where the banks did not provide liquidity and did not take on risks. So my question is really, why do we think that mismatch sort of continues to persist? And perhaps I will also note what was perhaps less surprising to me, but interesting to hear it was surprising for the bank, was the behavior around the corporate bond markets. So IOSCO did a big piece of work on that following the COVID market stress, where we looked at corporate bond markets and specifically dealer behavior. And it was, we basically found there were no buyers to be found. And it's interesting to see that the pension funds are still sort of a driving force behind the sales, as opposed to perhaps mutual funds. So it makes me wonder a little bit why funds or market participants would still seek to raise funds under stress by selling corporate bonds, particularly in a relatively small market. I'll stop there on the SWES. Do you want me to cover the other paper as well, or?
Yeah, I mean, please.
Sure. So I'll be brief also. So on macroprudential, first of all, really good and comprehensive response to the macroprudential consultation. I would say, as the paper already mentions, there is a lot of work that has already been done in some of the key areas, particularly around liquidity risk for money market funds and open-ended funds. I think generally there needs to be a lot more emphasis on implementation of what has already been done, particularly in open-ended funds. Firstly, as already mentioned by Francois, the revised FSB recommendations, and also IOSCO's guidance on liquidity risk management tools, which were published last year. They still need to be implemented. And then IOSCO, just last month, we published our consultation on revisions to our own liquidity risk management recommendations. And in this part, we particularly emphasize the use of the bucketing approach for funds, which I think goes to the heart of some of the concerns around liquidity mismatch. I generally really agree with the emphasis on the data and tackling the challenges around data quality. I think in order to effectively diagnose risks and vulnerabilities in NBFI, the data is essential, and it's essential that it's in the right hands. Perhaps sort of a concluding remark is, generally it seems to me that macropru is perhaps a bit premature, mainly because what I mentioned on implementation, but also because I think areas like the system-wide stress testing is a really great initiative. It provides perspective that I think has been lacking. It's also potentially very useful in identifying some of the gaps. And it seems generally a more efficient approach in the near term than making further considerations on broader macroprudential tools. So I'll stop there. Thank you.
Thank you, John. I think probably others will have also the time to react, but my first reaction to you is these exercises are replicable on the international scale. I mean, I understand from Lee that it will be trying, but certainly communication here among public authorities across the globe is extremely key, and that's why it's also important discussing about data and data sharing. Challenges are there, but indeed, it's an important point. And implementation, absolutely. In our consultation, we mentioned that there is still a lot to implement. However, I wouldn't lower the bar and attention on the issue. So they might be still gap. Stress testing exercise might be a useful tool, but I think also this kind of consultation, monitoring might be a useful exercise. I would give now the floor to Torsten. Torsten, back for his reaction on what has been said so far, or his perspective more from an academic point of view and therefore free thinker point of view. Torsten is also part of the advisory scientific committee of the ESRB, so has multiple hats, so you can give us multiple perspective. Torsten, please.
Thank you very much, Emiliano. I'm not going to comment directly on all of the aspects of the two excellent presentations, but I just want to make some more general point. And actually, I want to start with one point that we should not forget at all, at least from the European perspective. We do need non-bank financial institutions. I mean, there is this word bank bias that was framed, actually phrased, coined actually by one of my predecessors, the chair of the advisory scientific committee, Marco Pagano, some 10 years ago. I think it's important for us to move away from the bank bias and have a kind of diverse financial landscape with different non-bank financial institutions. And it's actually happening. So I think there has been an uptick in the size and the activity of non-bank financial institutions. I think that is, in general, with, of course, caveats, a good thing. Now, the other thing, so that's number one. And number two, the other thing I want to really stress again is there is an incredibly important cross-border dimension to non-bank financial institutions, especially if you look at the investment fund sector within Europe, which has, of course, lots of inflows from outside the EU, but also invests a lot in outside the EU, including in non-EU currencies. So I think the cross-border dimension is important to stress, which raises, of course, the issue of cooperation across borders, also between supervisory authorities across borders, of course, which is not always an easy thing, as we certainly know. Maybe so I found maybe a short comments on what Lee presented. A very interesting exercise, I would argue. I would say what I find, what for me, kind of the follow-up question would be, where did you see the frictions? I mean, where was there, where was the potential for things to go wrong? And I know it's sometimes you can only see it exposed, as for example in the mini budget crisis in 2022. But where would you see this in this exercise? And do you also see points where, for example, the Bank of England would have to step in, either with supervisory tools, financial stability tools, or with monetary policy tools? The other question I have is, in the exercise, did you actually notice any players that were mentioned by the participants that were not on your radar screen? Because one of the things, I'm going to come back to this in a moment, is we focus on the institution that exists out there or that we know about, but of course the NBFI universe is a huge one. And I think one of the tasks of macroprudential authority is to kind of screen the horizon scanning, kind of see what new sources of risk are about to emerge. And that can, again, be linked to specific new players popping up that are not quite on the radar screen yet. Now, I'm coming very briefly to what Francois presented, and as Emiliano already pointed out, I'm part of the ESRB structure, although of course, now I talk about as an independent academic here. And of course, some of this, the recommendations that Francois mentioned are actually also mapped by what has been discussed within the ESRB. Some of it actually has been already published as a report, which is actually in response to the inquiry, which I think actually Emiliano sent us. Well, officially it was the Commission who sent it us, but I think Emiliano was involved, to which we responded, and one of us was a large report, which actually on the ESRB website, but also in other discussions which have not been published yet. There are also discussions exactly along the lines of kind of a broader stress test and a more holistic approach to the financial system in the EU. Again, both taking into account linkages across segments, but also linkages across different countries. And I think that's important. Notwithstanding, of course, that macro-pru in the EU is on the national level with a few exceptions. So I think that is something to keep in mind. I mean, we have this coordination mechanism called the ESRB, but of course, there's a more fundamental question whether this is actually enough. Now, one last question I want to bring up before I finish is that there is this question, number one, what do we actually regulate? and where do we need data? And actually, we had a very interesting discussion on that in the ASC, in the Advisory Scientific Committee. And of course, there is a pushback also now against too much data collection, because it can be a burden, actually, both for those who have to provide the data and for those who have to collect it. But the question is, where do we collect data? Where do we monitor? And of course, there's a sequence here. First is decide, is it actually important to monitor, to get data? And only second, after the data, the monitoring, is it actually does it make sense to regulate it? And one way to look at it from the pure macroprudential viewpoint is it only really makes sense to regulate it if it's an activity that can have a systemic risk impact during a crisis situation. So it's not the riskiness by itself, as long as it's not affecting the overall financial system. So let me stop on here. Thanks, Emiliano.
Well, thank you, Thorsten. A lot of useful input. I have some of the same questions actually you had and you asked. So, I would also like to recall that the SRB respond to the consultation. The last two questions on what we try to regulate and the question on data is extremely relevant. I want to connect to your first point, no, NBFI. I think all this activity is not meant to reduce the activity of NBFI, but actually it's very much appreciated and related in the EU, for example, context to the CMU, what we call CU now. So we want more NBFI, of course, with more financial stability and also with the tools basically to monitor that element. And here I would collect also to what's happening now in the market, not the link more and more to private credit and the links between banks and the non-banks, which is more and more prominent. I would here take the opportunity. This is mentioned in the financial stability report of the FSOC of the US Treasury. Maybe this could be a nice link to giving the floor to Sarah Hammer. Samar, you join us later, but I made the introduction at the very beginning. So it is as if you were with us at the very beginning, even if you just missed a few minutes. Sarah, please.
Thank you, Emiliano. I appreciate it. And I'd like to thank also the Florence School of Banking and all of our other discussants and participants here today. It's a great opportunity to connect with all of you. I know you introduced me earlier, Emiliano, but I'd like to briefly provide some additional context for my perspective on this conversation. I'm sure you mentioned I am executive director at the Wharton School, and I lead strategic financial initiatives there. I'm also on the faculty at Penn Law, where I teach alternative investments, financial regulation, and am academic director of the AI and digital assets executive education programs. I am a former regulator. I served as Secretary of Banking and Securities for Pennsylvania last year, including through the regional banking crisis. And that gives me a unique perspective on the failure of regulation and the importance of focusing on the increased digitization of our markets, not only here in the US, but globally. I also formerly served at US Treasury, and I come from the asset management side, where I was a trader, market maker, portfolio manager, and investment strategist. So I'd like to go immediately to the topic of systemic risk and reiterate that my view is that the key when we think about systemic risk is the rich and functioning capital markets and credit provision and the importance of it globally, as well as in particular here in the US, where we have very strong, very resilient capital markets. I believe that there is a strong need to define the term systemic risk. I have repeated this in many conversations. And the reason I think that is important and that it's key to approach systemic risk with precision is because legally, what systemic risk implicates is taxpayer dollars in the United States. So when the United States government has to step in to bail out a financial institution or a group of financial institutions, taxpayer dollars are used. And therefore, I think it's incredibly important to think about the term systemic risk from an analytical perspective. And yes, using data, but noting that it can be burdensome to provide vast amounts of data. In the US, following the Great Financial Crisis, the Dodd-Frank Act eliminated the ability of the government officials to use a systemic risk exception for a single financial institution. But it was used last year during the regional banking crisis. And that is when we saw the failure of Silvergate Bank in California, Silicon Valley Bank, Signature Bank, and First Republic. Each business model for those banks was different, but one of the key commonalities was interest rate risk. And mismatch interest rate or duration risk in their portfolios led to the demise of some of those institutions. The other key was a digitization of the markets. And as we all saw, the speed at which information is passed through social media had an effect on venture capital activity, withdrawals from banks, and communications across institutions and markets about what activities participants would take. So I think there's still additional thinking about the regulatory fallout in that space that has not yet been resolved, including the thresholds in our regulatory framework here in the US, the need for depository insurance and how much should be provided, and conversations about additional capital. But I would emphasize that holding more capital, especially for large financial institutions, which we rely on to provide credit, and for asset managers, is not necessarily a solution to systemic risk concerns. And in fact, it can hamstring our financial institutions for the things that we talked about earlier in this conversation, providing capital and rich capital markets and credit to financial institutions. I think we're short on time, so I'm going to mention a few other things. I fully agree that a systemic risk approach to asset managers is not appropriate in many cases. The reason is the asset manager business model is an agency-based business model. And legally here in the US, asset managers, almost all of them have what are called lockups in their funds. So in the case of a crisis, an asset manager may have fluctuation in the assets in their portfolio, but they're not daily marking to market as a money market fund would do, so that investors could withdraw. And B, they have fund lockups, meaning they can inform their investors that they will not be satisfying redemptions. So I would urge us to consider the importance of analyzing the business model and what is an appropriate response to a stressed situation. Holding more capital is not a solution for asset managers or agency-based business models because it does not address the issue of liquidity. We talked earlier about money market funds. As we all know, we've had several money market fund stress situations in the United States and globally, including during the Great Financial Crisis and COVID-19, and again in our regional banking crisis. We have a unique structure here in the US for money market funds as it relates to Rule 2A7 and provisions for accounting treatment. And there are certainly considerations that our regulators will continue to analyze regarding money market funds, but the legal structure is very difficult to change. There have been many different attempts at regulatory reform, but I'd also note that money market funds here in the US are essential for strong market functioning and also state and local financing. I'll jump to two other things before I conclude. One is there was a mention of balancing cost and benefits. I agree that's very important. US law does call for it at many of our regulatory agencies, and the key is actually implementing it. So I think, again, looking at available data without increasing a burdensome amount of data collection and using advanced technologies to do so, such as artificial intelligence, is very important for regulators and policymakers. And then the last thing I'll comment on is global coordination and internationally agreed reforms. And I'll note that here in the US, as I'm sure you all know, we are still in the midst of the Basel III endgame discussions and conversations about appropriate measures for liquidity, which I have been a proponent of thinking about the fact that existing measures, the net stable funding ratio, for example, being a year-long measure, and the liquidity coverage ratio being a monthly measure, are not appropriate for today's liquidity markets, where digitization and social media and the vast acceleration of liquidity is a different type of challenge for regulators to think about. So I want to thank everyone for their important points and the opportunity to be here today. I look forward to continuing the conversation with all of you.
So thank you very much, Sarah. I think very good points. Just a few remarks, but just to say that after my remarks, probably if they want, I will give the floor to Lee and Francois if they want to react for 2 minutes each maximum. A shorter time, but I think it will be important. I think you mentioned very important points, systemic risk definition. Also building on what Torsten said, this might become eventually a dynamic definition. This evolves over time, also looking at the risk. You mentioned the important point of data, and indeed in Europe also we're having a quiet discussion about data reporting, but there's also a way of having smart reporting, no? And I think the stress test tool might be a useful tool to use the data which is available and maybe use it in a more or in a smarter way. And this links also to the point that you raised. Now, capital is not only the only solution. There are also the means of supervision, and I think therefore there is a lot of discussion around the stress test exercise. So now, conclusions to Lee and Francois, 2 minutes each. Thanks a lot for staying with us despite the delay.
Thanks, Emiliano. Thanks everyone for bearing with us. It sounds like we need a part 2 of this, right? Because there's so much rich discussion in here. I'll just pick up a few things that were mentioned on our work. So I think John talked about the corporate bond market and pension funds and the kind of price insensitive selling. I think in a way that's the beauty of the importance of these exercises, right? That we see that and we can kind of look at those things and quantify them and understand the magnitude. Because you're right, John. I mean, we know that corporate bond markets are typically exhibit low liquidity, but it's quite hard to understand the dynamics in stress all the participants without doing exercises like this. I would underline it was a very severe scenario as well. So in a way, as you said, some of those results are not surprising. On why the mismatch is still there, we use mismatches as a broad term in that we're thinking about price insensitivities. We're thinking about not understanding your investor base reaction functions if you're a fund perfectly in stress, and we're thinking about expectations of how and when you'll source liquidity. And I hope what the SWES has done is help iron out some of those mismatches, and we hope that participants will reflect on them a little bit too. I mean, we wanted this to be a two-way exercise. John, you asked about whether system-wide exercises would be possible elsewhere. Francois talked about that as well, and Torsten. I think it would be. We spent 6 months planning this exercise. I don't think you always need to spend that long, but I think it is really important to invest in planning to make it as efficient and effective as possible. And then Torsten, you asked about whether there would be frictions, where the frictions were. I think I saw them as the willingness of participants to step in stress. We understood how banks would operate in stress. The price insensitivity point I've talked about. So funds seem to be quite price insensitive in stress because their investors have liquidity needs to meet. I think that's a really important piece of information. One last point, and this is in the debate around macro and micro PRU. I do wonder if macro PRU really is just micro PRU with a system-wide lens, because a lot of these things we're talking about are good for investors too. I'll stop there.
Thank you, Lee. Francois, please.
Yes, thank you. I will be very, very brief. First of all, on the point made by John, whether a macro PRU framework is premature, I really do not think so. I think we need to implement this kind of system-wide exercise the way Bank of England did it, and I hope we will do that soon in Europe, capitalizing on the experience of Bank of England. Definitely a lot of food for thought in that. But I think it's we already have a number of experience from the past, even from the recent past, to help us build what a macro-prudential framework should be. Of course, this system one exercise will fuel into this reflection and will help us. But I think it's we should not wait to start thinking about what a macro-prudential framework should look like. And that leads me to the second point, reacting to what Sarah just said. I don't think, I mean, as I said initially in my presentation, we are not looking at replicating the prudential framework that is applied to banks, in particular capital. The idea is not to impose capital requirements. The idea is more to develop the tools that we need to better manage liquidity mismatches and leverage. And there are a number of reasons why this is needed. I mean, there are tools already at the disposal of asset managers, at funds, but there is no global idea, no global understanding of the possible externalities of these actions. And I think that's why this broader view can be taken by the public authority within a macro-prudential framework, precisely to address the possible externalities that the action of market participants, NBFI participants, can take at some point in time. So I think this is really needed, but we are not talking, at least in our recommendation, we are definitely not talking about capital requirements for asset managers. That's not the point in my view. I will stop there. These were the 2 points I wanted to react to.
Thank you, Francois. I mean, I would like to really continue, give the floor back to Sarah and then Thorsten and John. As Lee said, probably there will be space and opportunity to repeat the exercise. For your information, we will publish as a commission a summary of all responses to the consultation on our website in January. So let's see if as a follow-up we can repeat this exercise. But let me conclude, first of all, thanking in reverse order Sarah. Sarah, thanks a lot for joining at 8 o'clock in the morning. So we really owe you. Thanks a lot for being with us.
Thank you.
Thorsten, thanks a lot also for your quick and independent remarks, I would say. John, thanks a lot also for bringing the supervisory perspective and the challenging questions. I would like to thank again Sandra Lee. I know that she would have liked really to stay with us. I was talking to her a few days ago. I mean, it's a little bit unfortunate. I mean, probably we should repeat just for her. Francois, thanks a lot for the presentation, very useful, and for the whole work that you've done in the high-level task force. And finally, Lee, thanks a lot for this nice presentation and for all the work you've done with the SWES. It's a point of reference for all of us, and we'll certainly engage and continue to be in touch. So thank you, and also to the participants who followed us. Sorry, I didn't see any question in the chat, so that's why I didn't pick it up. But probably there was so much information to process today, so we might need to repeat. So thank you, and have a nice holidays if I don't see you.
Thank you.